Let me tell you, in this AI technological revolution, the ultimate winner might not be the companies that master AI, but the one that controls the power switch. Would you think buying it makes more sense than buying chips? In the last episode, we talked the biggest risk in AI is not its failure, it's that profits take too long to materialize. If the big model companies and chip companies are all anxious about making money too slowly, what should we do as ordinary investors? The most intuitive reaction is to stay away from AI. But there's a counterintuitive choice. Find a company. A company doesn't train models, doesn't sell GPUs, and doesn't need to guess which model will ultimately win. As long as data centers, servers, and everything AI related needs safe, uninterrupted power, this company, Eaton, will charge for it. Today's video is to tell you two things. First, Eaton's logic is rock solid. Second, Eaton's stock is not cheap. If you blindly buy it as a defensive stock without considering price and position size, you might make the wrong move on the right stock. All the AI companies are competing for the same gold medal, but for Eaton, who wins doesn't matter. As long as the race continues, more and more electricity will be needed. Everyone thinks of AI as software, as code, but in the physical world, it's current flowing through servers, transformers, switchgear, UPS, uninterruptible power supplies, coolers, that ultimately becomes computing power. If any single link fails, billions of dollars in computing assets become a pile of scrap metal. What makes Eaton special is that its products cover almost every link, from the grid entrance all the way to chip cooling. Moreover, the construction cycle for power systems is far longer than the iteration cycle for software. An AI model can be obsolete in a few months, but a substation or a power distribution architecture often involves years of planning, certification, and construction. This is Eaton's strength. Its order visibility is often higher than the revenue visibility of downstream application companies. But demand certainty doesn't mean Eaton's stock price is safe. The market isn't stupid. This logic has long been discovered. Capital has already used higher valuations to buy years of future orders in advance. Let me tell you a simple truth. If you're in an operating room or in a trillion-dollar cloud data center, what's your number one requirement for power equipment? Is it cheap? No. The number one goal, it must never lose power. Eaton's true moat is that customers are afraid to switch away from it. Once Eaton's equipment is in the system, subsequent expansions, spare parts, and maintenance tend to stick with the original supplier. Power equipment costs are a small fraction of the total project budget, but the cost of failure is extremely high, and Eaton can package a bunch of miscellaneous devices into a complete solution, saving customers the headache. The data also proves this isn't just storytelling. In Q4 2025, Eaton's equipment orders grew about 200%. In Q1 2026, total orders were up 42% year over year. There is a very noteworthy situation here regarding how ordinary investors should position their portfolios. Orders are the entry point to future profits, but they are not profits themselves. If orders are up 40%, but revenue is only up 17%, and margins haven't kept up, that means the company is paying a huge cost for expansion, supply chains, and hiring. In Q4 2025, Eaton had great results, but its guidance for the next fiscal year missed the most optimistic expectations. The stock fell more than 6% pre-market. In Q1 2026, results hit another record. Earnings per share beat expectations. Orders surged 42%. The company raised its revenue guidance, but only slightly raised its EPS guidance. And the result? The stock fell another 6% or so. Why? Because the market no longer rewards strong demand. The market is asking, why did revenue grow so much, but earnings per share didn't keep up? The answer is expansion investments, acquisition integration, capacity ramp-ups. All of these are eating into current profits. So going forward, the most important metric for Eaton is no longer how many orders, it's incremental margin. That is, for every extra dollar of revenue, how much operating profit and free cash flow is actually left behind. There's one more thing many people overlook. Eaton spent $9.5 billion to acquire Boyd Thermal. This deal gave Eaton liquid cooling capabilities, creating a closed loop from power supply to heat dissipation. Great, right? But at what cost? Before the acquisition, Eaton had a very clean balance sheet. After the acquisition, Eaton took on new debt. It now needs to use its cash flow over the next 2 to 3 years to prove this massive acquisition was worth it. If integration goes smoothly, this is a growth asset. If returns fall short, the new debt will amplify the current high valuation risk. Now look at the price. As of mid-July, Eaton is around $407. The market expects about $13.27 in earnings per share this year. What does that mean? About 30.7 times earnings. 30 times isn't a bubble for a high-quality industrial company, but it means the market has already paid a pretty high certainty premium. That is, Eaton has to deliver on 3 things. 1, revenue maintains high growth. 2, profit grows faster than revenue. 3, free cash flow re-accelerates after the acquisition. If any one of these falls short, the valuation could compress from 30 times back to 25 times. Even if earnings are still growing, the stock will feel the pressure. Technical analysis won't tell you what the company is worth, but it will tell you what price the market is willing to pay for this story right now. $425 to $437. This is the resistance area near the prior high. Without an earnings upgrade and heavy volume, chasing here offers terrible risk reward. $395 to $400. This is the first observation zone, the area where buyers stepped in after the recent drop. $360 to $370. This is the more important medium-term zone. If the fundamentals don't change, revisiting this level would significantly improve the margin of safety. Based on this structure, my conclusion is very clear. Don't chase immediately, buy it gradually. First tranche, wait for stability around $395 to $400, or for a quarterly report that confirms margin improvement. Then build a small observation position. Second tranche, wait for the next earnings report to verify free cash flow and post-acquisition leverage, then consider adding. Third tranche, only add after a confirmed breakout above the prior high with a successful retest, or if it drops to the extreme safety margin of $360 to $370. Let's say in a $100,000 account, Eaton could be around 10% to 15%. Its function is to hedge the volatility of portfolios that already hold AI stocks. Please remember today's conclusion. Eaton is a high-quality industrial asset worth long-term attention, but it is not a stock you can buy with your eyes closed. No one is. Truly good investment opportunities usually come from one of two situations. Either the price corrects, but the order logic remains intact, or earnings grow quickly, go through time to digest the valuation. So when AI really reaches the next stage, what we'll need to consider more is, are related factories willing to pay for efficiency? Next episode, we leave the substation and walk onto the factory floor. We'll look at a company called Rockwell Automation, and we will find out that is it the gateway for AI to enter the real economy, or it is just another traditional industrial stock masked by a long-term narrative still carrying cyclical pressure.